The ISM manufacturing data falling to 48.5 after 48.7. The median estimate was 49.5, so that is again below that estimate. We did see production and new orders rising just a touch here. Imports, however, fell to the lowest reading in 16 years. New export orders also fell to the lowest in 5 years, so perhaps a little bit of a fall off the back of an increase in purchases ahead of any trade issues that companies were anticipating here. Also seeing employment rising to 46.8 versus 46.5, potentially an indicator to look at ahead of that key jobs report coming in later this week. So again, that headline number coming in at 48.5 after 48.7 for ISM. Well, I do want to finally bring my co-host for the hour, Jay Woods, Freedom Capital Markets Chief Global Strategist. Jay, great to speak with you this morning.
Great to be back.
Thank you for being here with me. Talk to me about what you're seeing. I mean, I just read through some of the ISM manufacturing data here, falling just a clip. But what does it signal to you that every single data point that we are getting in feels so important right now?
It really does, because sentiment had been so bad for so long. So we're finally digesting some hard data. Well, is the sentiment justified? Is it going to be as bad as people think it was? And we're seeing some contraction with those ISM numbers under 50. It was expected. I don't think it was off that much where it's going to cause much fear in this market. We're still more concerned about anything that comes out of Washington on the tariff front than, the hard data. But that hard data is impacted by tariffs, and we have yet to see them really have that impact. I think the jobs numbers at the end of the week, not just the unemployment number, but the jobless claims, that ticked up surprisingly last week. If we get above 250, that to me would be a little head scratching. We haven't seen it get above 250 except for 2 times in the last 18 months, and that was due to hurricanes and a Boeing strike and a GM strike. There's nothing that will kind of say, all right, this is justified now. Yeah. But continuing claims have hit highs since 2021. So the hard data on the jobs front, I think, may be the story by the end of the week, but we'll continue to look at tariffs until then.
Well, it's all about the tariffs, but what's fascinating when you look at the S&P is that we're under 4% away from all-time highs now because of the run-up that we had in May. So does that, to me, it feels like the market has just said, okay, tariffs are over. How big of an issue is that if tariffs are not over?
Well, the S&P 500 is up for the year. This is insane. If you told us that we were going to have all this threat and no resolution to these threats and we were going to be flat, I would have taken that any single time. So we're not out of the woods. We still, we're so close to those highs, but what's the catalyst to get us to new highs? We had NVIDIA earnings last week. To me, that is the leader when you look at the Mag 7. That is a stock that led us from the bear market in 2022 to new highs. It was the first of the Mag 7 to get there. Microsoft was on the doorstep to new highs. Didn't get there. NVIDIA, it rallied, it faded after some solid earnings. So I think we still need a little more time, and that time will, could be a slow summer, but once again, whim of Washington. Let's see what happens on these tariff deals. We get a few deals in place. We were supposed to have 90 deals in 90 days. We have one with Britain, and I don't even know. It was a little wonky.
The concept of a deal.
The concept, everything's pushed back another 2 weeks. We'll see where this goes, but we're trading on hope, and then we can dig into it later, but this taco trade could have some impact on the market because if the president seemed a little annoyed by Trump always chickens out, if he puts his fist down and says, no, we're going through with these tariffs. We're seeing it in the steel tariffs against the EU right now. EU is going to push back. China and the U.S. are pushing back. We'll talk about that in the hour. So there's still so much uncertainty, word of the year, that some of this good news and some of the sentiment, I get the sentiment, but the hard data isn't really following through yet, but we're seeing some cracks. The ISM is one of those cracks.
Yeah, and there's so much uncertainty, but to your exact point, the leadership looks the same as it did when we came into this year. Can big tech, can NVIDIA continue to bear the weight of the entire market on its shoulders for the rest of this year?
Yeah, well, it rebounded. So we got back to levels. 4 of the 7 in the Mag 7 are up, 3 are down. So we're getting there, but it's not a tide lifts all boats scenario. And we have sectors, the industrial sector is the leading sector. No one talks about the industrials. That is actually a good sign of diversification and strength in the U.S. economy. We're still not seeing that hiring, but wages still remain at good levels. So there are just so many mixed signals that we are waiting for something to deflect. Jerome Powell will speak later today. Maybe he touches on that. But someone that was going one data point at a time, the data points have been good. It's the sentiment, it's the unknown that has us on edge. But the longer we go out into the year, we're halfway through now, we're in June. The Fed could cut if those jobs numbers do tick up a little bit and inflation remains as stable as it is. The PCE number came right in line. We're not at 2%, but we're at a nice level historically. So this bodes well for at least the Fed narrative to say, okay, maybe a cut can be on the table.